Hey guys, Stockaholics, appreciate you guys being here today. Today I'm going to be talking about technical analysis. It's not going to be the most positive video for technical analysis ever. I'm going to be talking about why I think technical analysis is a bit silly, but even though that I think that, why I'm learning it and thinking about it anyway. I know that I'm kind of a hypocrite on this topic because I do some rudimentary technical analysis when I'm thinking about buying and selling points for some of my stocks anyway. So I know that there's a lot of people that spend a lot of time as well on this topic, and they may have some passionate opinions. If you disagree with me, I'd be excited to hear your opinion on why, and you can let me know in the comments below. All right, so this is kind of how I see technical analysis. I see technical analysis as a self-fulfilling prophecy, and that it is one that skews heavily retail. If you guys don't know what a self-fulfilling prophecy is, I'll try and explain that. First of all, that is something that may or may not be true, but when somebody believes something to be true, that they ultimately make decisions that ultimately make it true. So I think that that's what technical analysis is. I think that all of these chart readings and these things that people do, I don't think that they are necessarily profitable in themselves, but I think that in certain situations they can become profitable just because everybody believes, or enough people believe that it's true that it becomes true. So to kind of show you guys what I think about that, I'll kind of share with you guys a story about me. And it's kind of embarrassing, kind of hesitant to share it, but I'll share it anyway. So now I don't want anybody to believe that I'm degrading them by making this comparison, because that's not really what my goal is here. But it doesn't change the fact, doesn't change my perspective either. Now, when I was in high school, my mom used to believe in astrology. She used to believe in tarot cards and that kind of thing. And because my mom used to believe in this kind of stuff, I would check it out too. Now, she had subscribed to some kind of horoscope kind of email, subscription or whatever kind of thing that you could get for free from some web. I have no idea what the website was anymore, but I would get those emails too. So I was like, because my mom likes it, maybe I'll check it out too, see if this stuff makes any sense. So I would get those emails and from the horoscopes, and the horoscopes would either have some kind of good news that you might look forward to in the day, or they might have some kind of bad news or something that you should look out for in whatever day that you're entering in. Now, I was in high school. And like a lot of young boys in high school, I liked girls. And one day I had a horoscope email that said something along the lines of that I should take this opportunity to capitalize on any romantic situations that I might be interested in. So there was a girl that I was fixated on, a girl that I liked at my school. And after reading this that day, I mustered up the courage to go and talk to that girl. Now, the encounter went successfully, in my opinion. I got to know her a little bit, and eventually that encounter led to a relationship that might not have otherwise existed. So ultimately, what this horoscope kind of did is because I believed in it, it made me do something I might not otherwise have. And it led to an outcome that became a self-fulfilling prophecy. Now, this is the kind of problem I have with technical analysis. You might see some expert, they'll kind of have maybe buy and sell signals, maybe the MACD and the RSI and stochastic indicators and whatever, Fibonacci retracements, something reason leads to these kinds of buys and sells. But I never really hear traders think about why. Why is this a buy? Why is it a sell? They look at these indicators and they say, okay, well, XYZ is telling me that I should make a decision and that I'm going to do it. And that likewise, XYZ indicator, well, is telling me now that I should sell. Now I'm going to make another decision, yeah? And you might see something like this. You might see, well, hey, but look, you know, if you had, they'll show you it with you any stock. If you had done whatever I had said and you listen to these indicators on this stock within this certain selected time frame, that it would have worked. And you know, the question that always comes to my mind is, again, is why? Why would that work? Why did that work in those specific instances? Is it because there's enough traders in these tickers to make it true? Or is it simply because it's true? Is it what is cause and what is effect, and what is effect and what is cause is kind of the thought process that goes in mind. Now, there's some other problems I have with this too, right? And it's that if you look at the data size, you look at the sample size for this, how many trades were there? There were 14 trades, right? Or let me count them. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. Okay, so I was right. 14 trades in this example. Now that's 14 trades is an extremely small data set. If you want to take any random stock and you want to make 14 trades on it, you know, you might select one that's going to be successful, and you might select one that's not. Now, likewise, if you'd ignored all of these buy signals and you just bought when things were dipping, maybe not somewhere in this dip, but in any of those other dips, and you ignored any of those buy signals, instead of the indicators telling you to buy it at a certain upward momentum, you would have made more money than you would have made using any of these indicators, right? Anyway, one of the things that I have, one of the biggest problems that I have, is that 14 data points is not a meaningful sample size. It doesn't show me anything, and I'd like to show you guys why. I don't do much of this anymore, but I am extremely familiar with quantitative assessment, and I'll kind of show you guys that. All right, so my opinion is that a lot of technical analysis experts, they often present what they're doing as quantitative, but rather their analysis is not quantitative at all, and that it's actually just incoherent qualitative analysis. And the reason I think this is I'll show you guys an example of what a quantitative analysis could look like. If you guys don't know, I've played a lot of poker before, and a lot of what I don't play as much anymore, just recreationally compared to what I used to play. But I've performed quite a bit of quantitative analysis. Now you can see here, this is kind of a data set. It's not showing you all of the hands, but it's showing you the hands basically by the amount of money that I played in this probably particular tournament that I played. So in this tournament, I played 435 hands, and I'd like to kind of talk about what you guys see here a little bit. Now, 435 hands, to kind of analyze and think about your profitability, how well you're doing, it's not a lot. So this is a massively small sample size. And what a lot of technical analysis experts do is they never talk about their win-loss ratios or even seem to have a concept of sample size. You know, like I mentioned in the last slide, that chart that you saw, if you followed it, you would have made money, but it's a small sample size. It's only 14 instances, right? Now, in fact, I almost never see anybody who does technical analysis review their past trades. They don't seem to want to share them at all. I only see people talk about current trades or maybe even future ones, yeah? It's important to look at large sample size. It's important to think about win-loss ratio. And this has to do with kind of the law of large numbers. As this kind of number here approaches infinity, the bigger and bigger that number gets, the more accurate you know your results are, the more you can have a perspective on what you're doing is either good or not. And your results, and you can figure out what your results are and if they were likely to repeat in the future. Now, this is a really small sample size. There's a lot of, you might be able to look at a few things, but this doesn't really tell me a whole lot. So here you can see most of my profitable and my most losing hands during a particular poker session. And, but however, in isolation, this is absolutely useless. And this is a much larger number than what we were just talking about. All right, so what we're looking at here is 14,000 hands, roughly. And what we're looking at is the amount of hands that I've played in a particular poker format at a particular stake. And it's important that these things stay consistent because I cannot assume that all things are going to stay the same as some of those variables change. Yeah. Now, as sample size gets bigger, patterns become more pronounced. You may notice that this is actually kind of showing some things that maybe the last chart was not. You may notice that some of these better hands we're making more money from, right? For example. But now I can start to see if things do make sense or if something doesn't make sense. Now, for example, if you look at this grid, there's some outliers, some things that that might show me some things that I might be doing correctly, and some things that I may want to think about to see if what I'm doing in these, we'll call them trades, makes sense. Now, if you look at this grid, for example, something I'm seeing that doesn't make sense are some of these hands in here. You can look at this one, 9-9, for example. If you look at any of the other pairs that I have in this set, except for 4s, but 9s is a much stronger pair than the rest, you notice that it's a very unprofitable hand. So that might tell me that I'm doing something wrong. Same could be said for Queen Jack. If you look at all the hands around this, they've been profitable in some respect, but this one hasn't. Is there something that I'm doing with this hand that doesn't make sense? That might be something I'd want to go and look. Same thing for maybe Queen 10 suited. It's a completely playable hand compared to King 10 and Jack 10. What is it that's so unprofitable in these ones compared to the ones around them? Maybe it's just luck of the draw. Maybe this is just not a small enough sample size. Or maybe I can go and look at the data set that I have and look at those hands to see if perhaps there is a flaw in what I'm doing. So now what I can do, I can go and see, look at those outliers in individuals. So for example, here you can see I'm going through the list of 9s. This is something that I've done beforehand, and I can see, okay, you know what, does this data set make sense, or was something out of whack? And I can look through some of those hands, and maybe I can identify something that poker players might call a leak in their games. I can find those things that I might be unprofitable in, and then I can think about what I can change. Again, this is a process that I never see. I never see, and I'm not saying that nobody does it. I'm not suggesting that, but I'm just saying of the technical analysts that I've looked at, I don't see anything that resembles something like this. All right, so based on what I did, some rudimentary analysis that I've done tonight with not a lot of time, but I've come to some conclusions. I've noticed based on this data set, in the stakes that I'm playing, in isolation, in the format that I'm playing, that I have an idea that I am making a mistake with 9-9. I'm playing it in a certain way, in a certain format, against a certain set of opponents that will have a certain, and I've come up with a rough probability of this thing working or not working. And what I've learned is that I need to be playing these hands more aggressive. It means I need to be re-raising this 9-9, and I'm not doing that enough for whatever reason. Perhaps a psychological condition where I see this hand and I think about it, okay, well, this is a 9s, maybe I should call this. I need to think about playing it another way. Now, what I've analyzed is that based on what I've been doing, that I have a 60% probability of losing money. And this is something that I never see. I see people present their technical analysis as if it's quantitative, but I never see them say, okay, what probability does this trade have of succeeding? You should know if you're going to be doing technical analysis. You know, you're presenting this information as quantitative. Shouldn't you have a quantitative percentage understanding of the success of a trade achieving what you want or not? And that's just something I never see. So that's something that it just doesn't make sense to me. Now, I'll make some caveats to that too. Yeah. If this data is for playing penny stakes poker, I can't assume that all the trends are going to be true for high stakes poker. I think in this data set that I was looking at, I was playing 10 cent, 25 cent. If I looked at all this whole data set and I said, okay, I'm going to play the exact same way, but now I'm going to take this data set and I'm going to assume that it's going to work in ultra high stakes poker, and I'm going to play against Tom Dwan or whoever, insert famous poker player you want. No, I can't assume that. I can only assume that it will be true for this format in this stake against this player pool that I've played against. Yeah. Now I can't assume that this is going to translate into other formats and other players, right? This is the problem I have with a lot of technical analysis, is that technical analysis often make what I believe to be a false assumption that all conditions are the same across all stocks. If MACD turns over, it's a buy. If RSI is oversold, it's a buy. If there's a golden cross, it's a buy. You can't assume that just because it might be true in one condition, under one set of circumstances, that it's going to be true across a broad set, across all kind of stocks, any stock that you choose. And it doesn't. You might be able to assume it with a large enough data set in isolation with this particular stock, but that's never something you see technical analysis experts talk about. So I'm going to leave my quote here. You guys can quote me on this. Technical analysis I have seen never do anything that resembles this process. They do not know probabilities. They do not analyze past trades, and they assume what they taught is true. All right, so this guy, he kind of did some scientific analysis of technical analysis and all kinds of different indicators to see if they actually work or not over different data sets. I'm going to leave a link because if I was going to go and talk about this, I could probably talk about this for 30 minutes, and I don't want to. But I'll leave kind of his closing remarks. After his study, what he noticed is this, and I'll kind of just read this. The results did actually surprise me. I didn't expect there to be a relationship at all. He found that when he was reversing the filtered indicators, that he may have alpha on the market for non-Bitcoin instruments. So what he's actually suggesting is that if you did the opposite of what a lot of traders use those instruments for, you'd probably make money. So that suggests probably more that a lot of traders lose money over time. And that's something that I've seen consistent in all kinds of sources, right? But he also mentions here, kind of like what I was talking about with data sets, is that he'd need a much larger data set to see if these relationships actually hold. One thing that's interesting, and this is kind of why I don't want to just throw a blanket statement, is that this statement where he says here, on reflection, this actually makes sense because Bitcoin is predominantly a retail product. And as we all know, retail love technical indicators. So what he found in this study is that some of these technical indicators actually did have alpha on Bitcoin. So what this suggests is that if you have enough traders in a lot, and what tends to be the case is that retail investors or tend to be traders, they tend to look at these kinds of things. And that's that kind of self-fulfilling prophecy kind of thing, right? So if you have enough people that believe in these indicators, and those people tend to be trading Bitcoin, then that would likely make these indicators true. This doesn't make them true on their own, but if everybody believes that these things are true, it will cause them to do things that otherwise would not be true. All right, but again, I'm going to put a link to this. If you're interested in this, check it out. Read through the whole article. All right, so if I have this belief set, and I think it's stupid, I think that it's not quantitative, and I think that it probably doesn't work, then why should I learn about it? What is the value in doing that? Well, I'm learning about it because I think everyone else believes it's true. Now, what we've seen in the past year, and we've seen the biggest retail surge in the stock market in recent memory. We've seen, if you look at the amount of brokerage accounts opened in the past year, it's kind of insane. And to me, that this shows that signs show that this isn't going away, at least probably until we see a correction or a significant crash again that causes a lot of these people to lose money. And then you imagine these guys, or at least I think, again, this is speculation, though I think a lot of those people will probably leave. But anyway, many of these people believe in technical analysis. And if those people are here and they're staying, they're going to likely drive instruments that they're involved in accordingly to the signs that they see. It's that self-fulfilling prophecy, right? Just like the study in the last slide, we need to actually analyze stocks in context within certain time frames. So if I think that this case is true, and I think that these guys believe in this certain set of conditions, and that those people are going to act accordingly, I do need to see that that it makes sense. So if I want to look for a retail stock that these guys are involved in within a certain set of conditions. So like, let's say, for example, the certain stimulus check environment we might be in, and we might want to see if this actually holds true. Now, I think that this guy here kind of gets it. This is a guy named Jay Bravo. I've watched his videos occasionally. He's kind of a doom and gloomer for me, but I still look at him. He's a trader. And I watch this guy, and I think that he kind of gets this. I think he gets this concept. What he does is that I notice that he trades a lot of these kind of retail kind of heavy stocks that, like for example, Tesla or EV stocks or whatever the flavor of the week tends to be. Yeah. And what I notice that he does is that he adjusts his buy and sell indicators to above and below what the popular trained consensus is. So for example, let's say that an indicator would normally say buy here and sell here. What this guy actually does is he adjusts it. He front runs this nonsensical belief set. So for example, let's say you're looking for a golden cross on the 200 day moving average. What this guy does is he looks for it a little bit sooner. He buys at 180 instead of 200. I think that there could actually be alpha in this if you can front run a retail segment that believes in this kind of nonsense. So I don't know. Maybe it doesn't mean I'm necessarily going to do it, but it does mean that I might be looking into a little bit more and at least trying to keep an open mind on if it can be a profitable strategy. All right, so I wanted to kind of close on kind of just maybe another qualitative analysis on trading itself, and that's kind of this. And it's kind of an analogy to think about why trading is kind of dumb. And again, I know I'm kind of a hypocrite in this because at least in the cyclical space, occasionally I engage in trading too. So you can call me kind of dumb for going against my own kind of belief set. But anyway. So let's say I didn't come up with this myself. I'm not that intelligent. I learned this from someone else. They came up with this analogy, and maybe I've heard this from a few different people, but I think it's kind of a good way to think about investing. So let's say that you go to the store and you buy a tangerine at the store, and let's say that it's $1. Now you go to the checkout, you pay that $1, and you go home. Then when you get home, you go around your neighborhood and you knock on your neighbors' houses and you say, "Hey, I got a tangerine here for $2. Would you be interested in it?" I think that's what a lot of traders do. They go around, they buy something that they think is likely to go up in the short or medium term, and then they kind of get rid of it. I'd like to suggest, you could do something else with that tangerine. Let's say you, instead of trying to sell that a tangerine at a higher price than when you bought it up, well, let's say instead you planted that tangerine in your backyard. Let's say you invest in a little small amount of soil and some fertilizer. And let's say said tangerine that you bought for $1 in the store turned into something like this, where you've got maybe 100 tangerines on that tree at any given year. You could go around and sell all of those tangerines at whatever the current market value is, instead of having to try and sell that one tangerine above what it would normally go for.